This week sees markets turn their attention away for a second from the US and instead focus on the ECB with the interest rate decision taking place on Thursday, the 12th of September. Let's get into what markets are expecting and what might need to happen for us to see volatility around the likes of the euro and the DAX. So here we go in terms of the outlook for markets. 25 basis point cuts pretty much across the board. In actual fact, we don't necessarily have it here, but the refinancing rate expected to drop by 60 basis points so that they can tighten the difference between the refi rate and the deposit rate. So don't be too surprised when you see that one of them was dropped by 60 basis points. It has been relatively well telegraphed. On this occasion, essentially, we're seeing a 25 basis point cut across the board. And so the question mark may not necessarily be about whether we see that cut, but about some other things. And those are the kind of things that could potentially bring volatility this time around. And it's more about the outlook going forward, really. Let me take you through a number of different things that give you a wider understanding of how things are set up in the Eurozone as things stand, and the kind of things that the ECB are going to have to contend with for the time being. First and foremost, headline inflation 2.2%. That's the same as the UK, but we have got August data for the Eurozone. We don't have it for the UK yet, so that's just July. The US headline inflation 2.9, or essentially 2.89 to be exact. And then in terms of core, it's quite interesting actually, because Eurozone core CPI 2.84, that's well below the UK and the US, both in the threes. So they've done a better job when it comes to driving down inflation. And you might argue that's because the Eurozone's been in a bit of a pickle, so to speak, and the likes of Germany in particular has not been the powerhouse that it has that we've grown accustomed to it being, essentially. And so inflation has come down to levels that likely enable them to cut rates. And they already have cut rates in the past. The expectation is that they will continue to cut rates. But the pace of those cuts will be key. And part of it will come down to the economy. Now, you might look at that inflation data and say that the job's been done, but you can look at wages in the Eurozone and see a reason why they might not necessarily cut rates at a very fast clip. Like we might not necessarily see these 50 basis point cuts. And that's because you can see here that the metric that we're looking at here is nominal compensation per employee in the Eurozone. I think it's around 4.8 here. You can see it's just below that 5% mark, some way away from that CPI metric. So we've got that big disparity between wage growth and inflation, and there's a question mark about, if we continue to see above inflation wage growth, is that ultimately going to spark a resurgence in terms of inflation, certainly as we see interest rates come down. So that's certainly something that might hold them back for the time being. In terms of the economic outlook, despite all the stories that we've been hearing about the weakness in Germany, it's actually looking relatively good. You can see the composite PMI moving towards the upside. That provides the expectation that we will see positive growth going forward. So there's talk of a recession in the US. It's not necessarily the same kind of talk that we're hearing in the Eurozone. However, there's a caveat to it, and the breakdown here shows you exactly why. This is all being driven by France at the moment. Of course, we see the Olympics over in France, and that's provided this big boost. You can see prior to the Olympics, we can see that essentially the composite PMI was in contraction territory, and we saw that resurgence at a time where we're not necessarily seeing that elsewhere. You can see Germany still in the doldrums when it comes to growth. And so really we're being reliant on a one-off factor that isn't going to continue to be there. Look, they'll get that boost and then it will fade away. And so certainly there's still some question marks around the economy for the ECB, which might provide the basis for them to continue to feel the need to act going forward. Now, the employment picture, of course, in the US, we're all talking about the jobs market. Well, Eurozone employment, we don't necessarily see that same sort of jobs report from the Eurozone. And that's why people are used to talking about average hourly earnings. We're not necessarily used to talking about your nominal compensation per employee that we have over in the Eurozone. But you can see here that this employment index has dropped back down to that 50 metric. And so it points towards weakness in employment for the region coming forward. So yes, we've seen this boost from what happened in terms of the Olympics. But that could be short-term in nature. And now we're looking at weakness in terms of employment. That could also lead to weakness in terms of the growth outlook. And we can see here with employment back down to that sort of 50 threshold area, you can see the future expectations are already in negative territory, moving towards the downside. And so there's question marks about whether with that weakness we're seeing in terms of the future expectations also play into the employment picture and point towards that further weakness. You can see that close correlation between the two. Nonetheless, the weakness that we could potentially see in the employment picture hasn't necessarily shown up yet. You can see here in terms of unemployment for the Eurozone. Well, that has continued to move towards the downside. I mean, it's above all of the other examples that I have here, so it's not necessarily saying they're in a great position, but nonetheless, it is moving on a downward trajectory. So we haven't seen any sort of major uptick in terms of unemployment, but it's also notable here that we can see here it's the likes of New Zealand and Canada that's really been seeing a strong move towards the upside. And for all of this talk about the Sun rule over in the US heralding a potential recession for the US economy, well, the gains that we have been seeing have been relatively steady in nature, and certainly the decline back down to 4.2 for the US has highlighted exactly that. But nonetheless, we're looking like over in the US is probably going to be a 25 basis point cut, but the CPI number is going to be key in that. But for the ECB, you know, we're continuing to move towards the downside. So that's not necessarily putting pressure, despite the fact that we are seeing signs of potential future weakness in the employment picture. Well, they're already cutting rates, and we aren't necessarily seeing an uptick in terms of unemployment. So as things stand, we're not necessarily seeing a huge amount of pressure being put on them. You know, inflation, is that going to do it? Well, inflation, it looks like, is going to remain relatively low. We can see inflation, as we've spoken previously, around target on that headline inflation. And if you look at the prices charged for goods and services from the PMI report, that remains at a decent level that would be consistent with us remaining around that 2% to 2.5% mark in terms of Eurozone inflation. That doesn't essentially signal, as we see this 4-month lead, doesn't signal this second wave of inflation coming around the corner. Now, of course, as you see interest rates being cut, so it impacts those expectations, and we could potentially see things tick up. But for the time being, we're not necessarily seeing that. What's notable is that the Eurozone already has interest rates that are way below some of its peers, as we can see here, that the sort of yellowy orangey line. And so with the fact that we're already below that 4% market for 3.75, there's already this disparity, and I don't think the ECB are really going to want that disparity to continue to grow. And that's because if we see interest rates too low in the ECB compared to, say, the US, then money within the Eurozone is going to flood out of the region towards assets and investment vehicles in the US, because if you're getting a guaranteed rate in the US that is much higher than the Eurozone, I just don't necessarily see a justification for you to put your money in the Eurozone, quite frankly. So they're going to want that differential between the two to narrow, not necessarily widen. That's one justification for why we might not necessarily be seeing 50 basis point cuts from the ECB. They're probably hoping that the Federal Reserve will be doing that, because then we start to see that narrowing, and it takes the pressure off when it comes to the ECB, that then they get greater flexibility. But they won't want a massive disparity between the likes of the Federal Reserve and their own rates. In terms of the expectations, market's pricing a 96% chance that we see a 25 basis point cut. So just a 4% or 3.8% chance that we do see a 50 basis point cut. It's not necessarily going to be whether we see this cut or not that's going to move the markets, because as you can see here, markets are so well informed. If we see a 96% pricing for a 25 basis point cut, it's going to be very, very likely that we do see that, because the ECB will be well aware of what markets are expecting, and they've been guiding it in that direction. Now, what's interesting is going forward from that, do we see a rate cut every single time? Well, market's currently pricing a no. So 60% chance that we see rates remain at 3.5% chance in the October meeting, with the next rate cut coming in December to top off the year. So the expectation for where rates are going to go going forward is going to be a key potential market mover. Do we see an adjustment where people suddenly start to look at the sort of commentary coming out of this meeting and start thinking, you know, we could possibly see a rate cut in October? Well, if we see that, then that brings the possibility of further euro weakness. It brings the potential for upside for stocks because of that more dovish outlook taking hold. Do they come out with a more cautious approach and say, we're going to just take it steady, we'll leave it a little bit of time and see how this rate cut feeds through into the economy? That's the kind of thing that could bolster that 60% and push it up for the October meeting. And it could strengthen the euro. It could weaken the likes of the DAX. So these are the kind of things that we're going to be looking out for in some of the commentary that comes alongside it from Christine Lagarde, because we need to know, what's the pace of downside in terms of rates, and also where's the terminal rate. Now, the terminal rate, or essentially the end rate that they're looking to target to halt the easing, it may not necessarily be something that the central banks are going to tell us in advance. In all likeliness, probably won't be, quite frankly, because they don't know what's going to happen. In a year's time, we could suddenly see a massive resurgence in terms of inflation. So telling us it's going to go down to, as we can see here, potentially 2%, which is what markets are currently pricing, that's not necessarily that helpful if you're then potentially having to underwhelm markets in the event that we see a resurgence in inflation. So whether we see that terminal rate really transmitted or not, that's going to be key going forward. But also the expectation in terms of growth and inflation, as we see here, we've got projections from the June meeting. We're going to get them once again this time. So as you see here from the release, there's always that relationship between the previous projections, and this time it was March, and then the current ones, which was June. So this time we're going to be looking at the September projections in comparison to the June projections. So where do they see real GDP? Where do they see inflation going? As we can see here, the expectation is that 2024 inflation is at 2.5%, down to 2.2, then 1.9. And then we can see here that significant disinflation getting us back down to target in 2026 for the core readings. So do we see adjustments that they actually see inflation coming in below that, and that would essentially push them a little bit more towards greater easing over the near term? And then what's the outlook for growth? Do they start to see growth fears coming into play that might force their hand as well? So adjustments to these outlooks will provide the basis for potential volatility going forward. Now, I wanted to bring up the chart for the DAX first and foremost. Here we go. So this is the DAX, and the DAX has been moving alongside the likes of, say, the S&P 500. The US market's really leading the declines of late because the talk is of a recession in the US. We're not all talking about a recession in the Eurozone, but nonetheless, as we can see here, both markets moving hand in hand with this recent downward pressure. But things are starting to turn up a little bit. And certainly there's been a lot of talk about how bad September is for equity markets. So does this provide the basis for a potential buy the dip opportunity for markets? Well, I would say so, but the dip is quite difficult to judge exactly where the bottom is. And, all I can say is, if I look at the long-term trajectory and I look that we're moving into a period where most of the central banks are going to be moving into a pro-growth strategy of cutting interest rates, I would expect that we should see a strong end to the year. But we don't necessarily know how far this pullback is going to come. Of course, we've got this bearish engulfing candlestick formation on the weekly time frame, points towards a possibility of further downside. You can see in terms of retracements that essentially we've seen shallow retracements, 23.6, into your mid-sized retracements, your 50%. Then we've come into this deep retracement at 61.8, and then we've seen the big pullback. So we've sort of been seeing it narrowing time and time again, and sort of bigger questions being asked, and then it pulls into this wider retracement. Well, now we've rallied up tentatively through into record highs and now sold off with the bearish engulfing. It points towards a possibility of further downside over the near term. And so the 4-hour chart, I think, is going to be key here. If we break the 186.80 level, that swing high, then this sell-off phase is over, and we've just seen an ABC-style retracement, and the bulls are back in play. But until that happens, there is still a chance that we see another leg lower for this market, because ultimately, we don't necessarily know how deep this retracement is going to go. And as we can see here, if we're looking at, say, deep fib retracements, we're somewhere away from that as things stand. And we just put all of the fib retracements on. So we can see that we've tagged the 38.2 at the moment. And so a recovery from here would essentially line us up with what was happening sort of in the early part of this phase. It wasn't necessarily what we were seeing more recently. We're seeing deep retracements. But of course, we've come a long way. So we've still seen a strong move lower, even if it, isn't necessarily the same kind of if we saw a 38.2 retracement here compared to, smaller moves, then you see different types of moves in the middle of these. So, the size of the retracement depends on the size of the run up into it, essentially, is what I'm trying to say. And so we are seeing the bulls coming back into play. There is still a chance that we roll over into a deeper retracement. Certainly the near term 50% tallies up with this 18,000 mark, tallies up with this area of prior support. So a number of support levels that would come into play at 18,000 if we get to it. But for me, it's just a case of following the near-term charts, so the intraday charts, and we can see recovering at the moment, but there's still a chance that we roll over, and we need to see a breakthrough 186.80 to really give us greater confidence that the bulls are back in play. And then looking at the euro against the Swissy, I feel like I've been focusing on the Swissy a lot recently, and for good reason. I think that essentially with the fact that we're only looking for 325 basis point cuts, and then they're done for the SMB, it's the same kind of thing as what's happening with the Japanese yen. Look, we're talking about rate hikes of 10 basis points over a couple of meetings from the BOJ, but all of a sudden you see that the Japanese yen strengthening. We're seeing everyone starting to sell off the likes of the US dollar. That's because we're preparing for a period of interest rate cuts from the Federal Reserve, whereas the BOJ are moving in the opposite direction, despite the fact that Japanese interest rates are rock bottom, the US interest rates at 5.25. So same kind of thing here. We've got 3 rate cuts ahead from the SMB, and then that's likely to be it. Whereas some of these other central banks could have a more protracted period of easing, which points towards a possibility of weakness against the Swiss franc. So we've got a wide bearish trend in play at the moment. It looks like we're somewhere in the middle of that downward move as things stand. The 4-hour chart shows you this sort of stepped move lower, and we've rallied up once again, but this time start to roll over once again. So let's just get the Fibonacci drawn on, and you can see absolutely perfect into the 76.4. Here's one I made earlier. And so we can see there perfectly 76.4 fib and then rolling over. So if we break this near-term swing high, which is 93922, then yeah, we could provide a wider retracement. But then it would be a potential retracement of the 944. So we'd really ultimately need to break the 0.94456 swing high to point towards more protracted move towards the upside. Until that happens, I think there's a good chance we do see downside. But really, the moves are going to come in line with shifts in expectations for future interest rate cuts from the ECB. Do we see them laying out a pathway that would include another interest rate in October and then one in December? That remains to be seen. But certainly when you look at the boost that we've seen from France recently, that's going to fade, and the growth prospects and the employment prospects are starting to sour. So there could be some justifications for the ECB to potentially get a move on. But like I said, there's also the fact that we have that differential between the likes of France and the US that they won't necessarily want to widen too much. So the actions of the Federal Reserve will also be key in the ECB's decision making as they go forward.